We're continuing on our series of videos on permanent life insurance. Today, we're talking about a policy that has flexibility on the payments that you make and on the death benefit. So as life changes, you can make changes. It's called the Universal Life Insurance Policy. Is it right for you? We're going to break it down as to how it works, and stick with me to the end. We'll talk about some of the risks involved in having this plan. So what exactly is the Universal Life Insurance Policy? Simply put, it's a permanent policy that should be enforced for as long as your life. I did say should. We'll talk about why. But it is a permanent policy similar to that of a whole life. That's a traditional whole life. Fundamentally, the difference is that the premium and the death benefit are adjustable. That means you're not locked into having to pay the same premium month over month or year over year. And you can increase or decrease the actual death benefit within certain guidelines of the actual contract compared to that of a whole life, right? Which has fixed premiums and a guaranteed cash value. Of course, the growth of the cash value is dependent on dividends, which are not guaranteed. But the universal life is designed for flexibility. But of course, that flexibility comes with some risk. We'll talk more about that later. Here's how it works. When you pay your premiums, part of the premium actually covers the cost of insurance. Then the balance actually goes into the cash value. That cash value then earns interest. The interest for a traditional universal life is based on the declared rates by the insurance company. Those rates are usually money market rates, which can change, can go up or down, but there is a minimum guarantee rate, which you'll see on the illustration when they show it to you. The biggest feature with the universal life policies, though, is that the cash value accumulated could ultimately grow so much that you could skip a premium or even stop paying your premiums overall. So it is good to ultimately do a review on your universal life policies annually, just to make sure that everything is going right with the plan. There are three main different insurance or universal life policies. You have the traditional universal life, which earns interest based on the declared rates from the insurance company. You have the index universal. So index, like the S&P 500, is where your cash value accumulates from. Usually there's a cap rate, for instance, 8%. If the market goes up 12, they'll give you only 8 on top of your money, but there is usually a floor. Then there is the variable universal life, which has your cash value invested directly into the market based on mutual funds. So you could grow based on the fund, 8, 12%. It all depends on how the market is performing with the fund that you're in.